Welcome to the Deep Dive. We're the show that really digs into the details to keep you ahead of the curve.
Glad to be here.
Today, we're diving straight into something super practical, unlocking serious tax savings hiding in your employee benefits.
Yeah, these aren't just little extras.
No, exactly. Think of them as real tools, powerful levers, really, to boost your finances maybe more than you realize.
That's the plan today.
Meh.
We want to cut through all the jargon, make sense of these fringe benefits.
Right.
And help you spot those moments where you go, I can use that in your own compensation package.
So the goal is what? Reducing your tax bill.
Exactly. Reduce your taxes, which means more take-home pay now or, more wealth down the road. It's about making those benefits work for you.
Okay, let's unpack this then. Lots of companies offer these employee benefits, but the key thing, like you said, is the tax advantage baked into many of them. It's crucial to really use these, optimize them even. It's part of your total pay.
Yeah, absolutely. If you're not maximizing them, you're basically leaving money on the table. Tax-free money sometimes.
Or tax deferred, yeah. A missed opportunity.
And the way they work is what's so valuable. They let you pay for things you probably need anyway.
Like healthcare, commuting.
Right. Using pre-tax dollars. Or your employer chips in money that isn't taxed as income right away.
Either way, less taxable income for you.
Exactly. Lower taxable income means a smaller tax bill. It's fundamental tax optimization within your job, making your salary work harder before taxes bite.
Okay, so the why is pretty clear. Keep more of your money. Let's get into the how.
Let's do it.
We've looked at some of the most common benefits with these big tax advantages, and maybe we should start with a real powerhouse for many people. The HSA, the health savings account.
Definitely.
This is the one tied to high deductible health plans, correct?
That's the one. And HSAs are often top of the list because of what people call the triple tax advantage. It's pretty unique.
Triple. Okay, break that down.
Sure. First, the money going in, whether it's your contribution or your employer's, is pre-tax. That means no federal income tax and no Social Security or Medicare taxes. Big savings right there.
Okay, that's one.
Second, the money in the account grows completely tax-free. Any interest, dividends, capital gains, all tax-free growth.
Nice. And a third?
Third, when you take money out for qualified medical expenses, doctor visits, prescriptions, dental, you name it, those withdrawals are also completely tax-free.
Wow. Pre-tax in, tax-free growth, tax-free out for medical. That's powerful.
It really is an amazing tool for healthcare costs and potentially long-term even retirement savings if you don't spend it all.
Let's put some numbers on that. We looked at an example, Alice. Her employer is pretty generous, kicks in $1,000 a year to her HSA.
That's a great start. Free money.
Totally. And Alice sees the value, so she also puts in $100 from each paycheck. That adds up, $2,600 from her plus the $1,000 employer contribution, so
Yeah.
$3,600 total for the year. Now, because her contributions are pre-tax, considering federal, maybe state, and those payroll taxes, she could easily be saving something like, say, $1,080 in taxes just from that $3,600 going in.
Yeah, assuming maybe a combined 30% tax rate. That sounds about right.
So she's basically paying future medical bills with untaxed money, and she got $1,000 free from her boss. It feels like a win-win.
It absolutely is. If you have a high deductible plan and you're eligible, you really should try to max out that HSA if you can, or at least contribute something. It's one of the best deals out there.
Okay, HSAs are great for healthcare with those specific plans. What about other sort of everyday unavoidable costs? That brings us to FSAs, right? Flexible spending accounts.
Exactly. Another way to use pre-tax dollars, but for slightly different things, or available with different health plans sometimes.
And there are a couple of main types.
Yeah, primarily two you'll see. There's the Health FSA. For 2025, you can put aside up to $3,300 pre-tax for out-of-pocket healthcare costs.
Like co-pays, deductibles, prescriptions.
Right, things your insurance doesn't cover. And an interesting feature of the Health FSA is that often the entire amount you elect for the year is available right from day one.
Oh, that's handy if you have a big expense early in the year.
Exactly. Then there's the Dependent Care FSA. This one's for childcare expenses, daycare, after-school programs, summer camps for kids under 13, or care for other qualifying dependents.
And the limit there.
That's typically up to $5,000 per household per year, pre-tax.
Okay, let's use another example. Bob and Carol, they have, like, serious daycare costs.
Very common.
So Carol puts the maximum $5,000 into her dependent care FSA. That decision alone could save them, what, maybe $1,500 or more in taxes, depending on their bracket?
Easily. federal income tax
Mm.
plus FICA taxes. It adds up quickly on $5,000.
And maybe Bob uses a health FSA too. Let's say $2,000 for the year for glasses, dental work, that kind of thing.
Okay.
That $2,000 pre-tax could save them another maybe $600 or so.
Sounds plausible. Again, depends on their total tax picture. But yeah, significant savings by paying for things they'd pay for anyway with pre-tax money.
But there's a catch with FSAs, isn't there? Something people need to watch out for.
Yes, a very important one. The use it or lose it rule.
Ah,
You
right.
generally have to spend the money you put into an FSA within the plan year. If you don't, you forfeit whatever's left over.
Ouch. So planning is key.
Crucial. Some plans might offer a short grace period to incur expenses, or maybe a small carryover amount, like the IRS allows up to $610 to be carried over for health FSAs if the employer adopts that option.
So you have to check your specific employer's rules.
Absolutely. Know the deadlines, know the carryover rules, if any. Also, for the dependent care FSA, just a quick note, you can't use the same dollars for both the FSA and the child and dependent care tax credit.
Ah, okay. No double dipping.
Right. But if your child care costs are more than the $5,000 FSA limit, you might be able to use the tax credit for the expenses above that limit. So again, a little planning helps maximize savings.
Okay, good tip. Let's shift gears to getting to work. Commuting costs can be a big chunk of the budget for lots of folks.
For sure. Public transport, parking, it adds up.
And there are pre-tax benefits for that, too.
Yes, under Section 132 of the tax code. These let you pay for qualified transit passes, van pooling, or work-related parking with pre-tax dollars.
How much are we talking about here?
For 2025, the limits are pretty decent. It's up to $325 per month for transit and van pooling combined, and a separate $325 per month for qualified parking.
Wow, separate limits, so potentially $650 a month pre-tax.
Potentially, yeah. If you pay for both qualified transit and qualified parking near work, annually that could be up to $300-900 pre-tax for transit and another $300-900 for parking, almost $8,000 total.
That's huge. Okay, let's take Sarah. She takes the train, spends $150 a month on her pass.
Okay.
If she runs that through her commuter benefit plan, that $150 comes out before taxes. So she's saving federal, state, if applicable, and FICA taxes on that $1,800 a year. That could easily be, what, over $600 back in her pocket?
Yeah, maybe around $624, assuming a combined 35% marginal rate on everything. It's like getting a couple of months of transit completely free.
Exactly. And if she also paid, say, $100 a month for parking at a lot near the office,
Another $1,200 a year pre-tax.
saving her maybe another $400-ish in taxes?
Roughly, yeah. It's free tax money for expenses you likely already have. Usually it's managed through a special debit card or reimbursement process. Pretty straightforward.
Definitely worth checking out. Now, beyond these benefits where you actively set money aside, what about just, regular health insurance provided by the employer?
Right. We don't always think of it in the same way, but employer-sponsored health insurance is a massive tax advantage benefit.
How so? We just see the deduction from our paycheck usually.
Well, two key ways. First, the amount your employer pays towards your premium, which is often a large chunk, is generally not considered taxable income to you. That's a huge hidden benefit.
Oh, okay. The employer's share is tax-free to me.
Correct. Second, your share of the premium, the part deducted from your paycheck. That's almost always taken out on a pre-tax basis through what's called a Section 125 cafeteria plan, meaning you don't pay federal income tax or FICA taxes on the amount of your premium contribution. So if your share is, say, $200 a month,
Yeah.
that $2,400 a year is reducing your taxable income, saving you maybe $50 or more each month just from that pre-tax deduction.
Okay, I see. So the whole structure is designed for tax savings. What about other insurance, like life insurance?
Good question. Employer-provided group term life insurance also have a tax break. Coverage up to $50,000 is generally tax-free to you.
And if they offer more than a $50K?
If the coverage exceeds $50,000, there might be a small amount of taxable income calculated based on IRS tables. It's called imputed income, but it's usually a very small amount compared to the coverage value. Still a good deal.
And disability insurance.
Disability is a bit different. The key is who pays the premium. If you pay the premiums with after-tax dollars, then any disability benefits you receive later are tax-free. But if your employer pays the premiums for you, or you pay with pre-tax dollars through the cafeteria plan, then any benefits you receive if you become disabled would be taxable income.
So there's a trade-off there. Pay tax now on premiums for tax-free benefits later, or get a tax break now, but pay tax on benefits if needed.
Exactly. It's a planning point. But overall, the theme is clear. Employer insurance contributions are generally tax advantaged for the employee in some significant way.
Okay, we've covered saving on current expenses, health, commuting. Now, here's where it gets really interesting for the long term. Building wealth. Let's talk retirement plan matching.
Ah, yes, the 401k or 403b match. This is often called free money, and honestly, that's not far off.
Why free money?
Because when your employer contributes matching funds to your retirement account, that money is not counted as taxable income to you in the year they contribute it.
So it doesn't show up on my W-2 as income.
Nope, it goes straight into your retirement account. It grows tax-deferred alongside your own contributions. So you're boosting your retirement savings significantly without paying immediate tax on that employer money.
Let's use Mike as an example. Makes $80,000 a year. His company matches 100% of the first 5% he saves.
Okay, a common matching formula.
So Mike puts in 5% of his salary, which is $4,000. His company then puts in another $4,000.
Right, a total of $8,000 going into his retirement account.
That $4,000 match from the company, he pays no current income tax, no FICA tax on that, right?
Correct. It completely bypasses current taxation. If he'd received that $4,000 as regular salary, he might have lost, what, $1,000 or even more to various taxes.
Easily.
Instead, the full $4,000 goes to work for his future, growing tax-deferred. And over a career, 20, 30 years, those matches, plus the compounding growth on them, it can add up to hundreds of thousands of extra dollars for retirement.
So the takeaway here seems pretty straightforward.
Absolutely non-negotiable, really. You should always contribute at least enough to get the full employer match. Otherwise, you are literally walking away from free, untaxed compensation.
Yeah.
Leaving salary on the table. Don't do it.
Got it. Max and match. Okay, what about people working for public companies? Sometimes there are stock plans. ESPPs.
Yes, employee stock purchase plans, or ESPPs. These can be another really powerful benefit, if offered.
How do they typically work?
They usually let employees buy company stock, often at a discount to the market price, maybe 10% or 15%, using money deducted from their paychecks over a set period, like 6 months.
So you're buying stock for less than it's worth on the open market. That sounds like an immediate gain.
It absolutely is. And here's the key tax advantage for qualified ESPPs, which most are. That discount you receive, it's not taxed at the time you purchase the stock.
Ah, okay, so the tax comes later.
Yes, you only deal with taxes when you eventually sell the stock. So that built-in discount, say 15%, is like an immediate tax-deferred return on the money you contributed.
Let's use Emily. She puts in, say, $300 each paycheck into her ESPP over 6 months. That's $3,600 total. Her plan has a 15% discount. So at the end of the 6 months, she uses that $3,600 to buy stock that's actually worth, let's say, $4,235 on the purchase date.
Right. An immediate $635 paper gain thanks to the discount.
So she's $635 ahead right away. Now, how does the tax work when she sells? You said it depends.
It depends crucially on how long she holds the stock. There are two main scenarios: a qualified disposition and a disqualifying disposition.
Okay, what's the difference?
A qualified disposition generally means you hold the stock for at least 1 year after you purchased it and at least 2 years after the start of the offering period, the date the discount was set.
If you meet both those holding periods.
Then the tax treatment is more favorable. The amount of the discount itself, the $635 for Emily, is taxed as ordinary income. But, and this is key, any additional gain beyond that, if the stock price went up even more after she bought it, is taxed at the lower long-term capital gains rates.
Okay, so part ordinary income, part potentially lower capital gains tax. What if she sells sooner?
If she sells before meeting both those holding periods, it's a disqualifying disposition. In that case, the entire discount, $635, is treated as ordinary income in the year she sells, and it gets added to her W-2. Any gain above the actual purchase price is then either short-term or long-term capital gain, depending on how long she held it from the purchase date.
So selling quicker means more ordinary income tax on that discount portion.
Generally, yes. The trade-off is getting your cash out sooner versus holding for potentially better tax treatment and maybe more growth.
What do most people do?
It varies. Some people sell immediately to lock in the guaranteed discount that 15% is hard to beat, risk-free, and then they reinvest elsewhere to diversify. Others aim for the qualified disposition to minimize taxes, especially if they're bullish on the company's stock. You also have to be aware of company trading restrictions or blackout periods.
Lots to consider there, but that initial discount is a powerful incentive.
Definitely. A 15% discount is like a 15% immediate return, tax-deferred initially. Very attractive.
Okay, one more major category. Investing in yourself through education. Companies sometimes help pay for that, right?
Yes, educational assistance programs. Things like tuition reimbursement, paying for certifications, or even sometimes helping with existing student loans.
And these have tax benefits too.
Oh yeah, significant ones. Under Section 127 of the tax code, an employer can provide up to $5,250 per employee per year in educational assistance, completely tax-free.
So if my company pays $5,000 for my course,
That $5,000 is not included in your taxable income at all. No federal income tax, no FICA taxes on it. It's just free money towards your education.
what if the course costs more than $5,250?
Generally, any amount the employer pays above $5,250 in a year would be considered taxable wages to you.
Yeah.
There's an exception if the education qualifies as a working condition fringe benefit, meaning it's directly related to maintaining or improving skills for your current job. But the $5,250 rule is cleaner and broader.
And you mentioned student loans.
Yes, there was temporary legislation, currently extended through the end of 2025, that allows employers to include payments made toward an employee's student loans under that same $5,250 tax-free umbrella.
Wow, that's huge for people with student debt.
It really can be.
So let's take Jake. His company has this benefit. He's taking night classes for a master's degree. The company pays $5,000 directly to the university for him.
Okay.
Jake owes zero tax on that $5,000. If he just got a $5,000 bonus instead, and he's in, say, the 22% federal bracket plus FICA, he'd lose over $1,100 of it to taxes.
Exactly. Instead, the full $5K goes to his education. It's essentially untaxed money for self-improvement, career advancement. If your employer offers this and it fits your goals, it's an amazing benefit to utilize.
Absolutely. Okay, we've hit the big ones: HSAs, FSAs, commuter, insurance, matching, ESPPs, education. Are there other, maybe less common things people should look out for? Any other hidden gems?
Yeah, definitely. Benefits packages can be really diverse. While those were the heavy hitters, you might also see things like direct dependent care assistance, where the employer subsidizes child care costs tax-free up to that $5,000 limit, similar to the FSA.
Okay.
Adoption assistance is another big one, though less common. Employers can provide significant amounts, currently over $15,000, tax-free for qualified adoption expenses.
Wow.
We mentioned group term life, up to $50 being tax-free. If your company runs its own commuter shuttles, that's usually tax-free. Sometimes subsidized meals in an on-site cafeteria can be tax-free if it's for the convenience of the employer.
Like if you can't really leave for lunch easily.
Right. Wellness benefits can be tricky. Sometimes cash incentives are taxable, but things like an on-site gym might be non-taxable. Moving expenses used to be deductible, but reimbursements are generally taxable now through 2025, unless you're in the military.
Good to know that changed.
And for people with things like stock options or restricted stock units, RSUs, that gets complicated fast. Different types, vesting schedules, tax timings, things like the 83B election. If you have equity compensation, you really need to understand the specifics of your grants and the tax rules. Decisions there can have huge financial impacts.
So specialized advice might be needed there.
Often, yes. The main point across all of this, though, is pretty simple.
Which is?
Know your benefits package, read the materials, attend the webinars during open enrollment, understand what's offered, and then strategize. Figure out how much to contribute to the HSA or FSA. Make sure you're getting the full 401k match. See if the ESPP makes sense for you.
Don't just check the boxes without thinking.
Exactly. A little bit of planning, especially around open enrollment or the start of the year, can save you thousands in taxes and really boost your overall financial picture.
So bringing it all together for you, the listener, the core message seems clear. By getting smart about these employee benefits, you're essentially giving yourself a raise.
That's a great way to put it.
You're boosting your take-home pay now, or you're accelerating your future wealth, all without needing a higher number on your gross salary line. It's just about using what's already available more effectively.
Paying less tax legally, getting more value from your total compensation package.
Yeah.
And maybe the final thought to leave you with is this. Take a fresh look at your own benefits. Which ones are you enrolled in but maybe not fully utilizing? The HSA you only put a little bit into? The commuter benefit you haven't signed up for? The 401k where you're not quite getting the full match?
Do the math?
Yeah, do a quick calculation. See what optimizing those could mean for your bottom line this year. Honestly, it's often the easiest raise you can possibly get.
Couldn't agree more. Go explore that benefits package, dig into the details. You might be really surprised by the extra financial power you can unlock.
Absolutely.
That's our deep dive for today. Go make those benefits work for you.